Hi everyone. Let's look at the second question 2 from the Prelim 2023 Gauteng paper. This is Cashflow and financial indicators. Right. Question is for 35 marks and 35 minutes. Right. The first question: choose the correct term to complete each of the following statements. Right. Only. So the terms that we have are in a box there. The mortgage bond to finance the purchase of new property. Right, so mortgage bond is a non-current liability or long-term liability. Right, then an increase in debtors will indicate an outflow of cash. Right, then packing material not used at the end of the financial year, that will be current asset. This will form part of your inventory. Right, remember on your note number 4, you have inventory, right, which is trading stock plus any consumable stores on hand, stock on hand, and other expenses that are used that have or might have stock remaining at the end of the year. Right, then for the increase in debtors, any increase in the cash flow statement of current assets is an outflow. Then any decrease in the current assets is an inflow, and the opposite is true for current liabilities. I say Ranga Limited, that's the company that we're doing. The information below was taken from the account records of Ranga Limited. The financial year ends 28 February. That's the financial year end. Calculate the following amounts for the cash flow statement. Right, you need to calculate inventory, right, on 28 February. You need to calculate income tax paid. You need to calculate dividends paid. You need to calculate purchase of fixed assets. Right, from the marks you can tell some of them are the straightforward calculation. Prepare the cash effects of the financing activities. There's 3 activities in the cash flow. That is the operating activities, financing activities. So it's operating activities, investing activities, and financing activities. Right. So here you're required to only prepare the financing activities. Complete the section of the cash and cash equivalents. Right. So you need to complete this section of the cash equivalents. Calculate the following financial indicators. Right. Net profit before tax on sales, right? Then current ratio, dividends per share, then return on shareholders' equity. I'm quite surprised about the current ratio, because in question 1 you had a question addressing the current ratio. I think that was enough to test you the knowledge of if you know the current ratio and what it means. But kind of like a bit weird for me that in question 2 they asked you to calculate the current ratio, whereas in question 1 they asked you to use the current ratio to calculate the current assets, right? Total current assets. So it's kind of like for me a bit unusual that they'll ask you the same ratio in one question after the other. I'm not sure, but yeah, that's what it is. Then right, then you are given information. Right, information A. Information from this statement of comprehensive income on 28 February. You got sales, depreciation, right, profit before interest and tax, interest expense, income tax, net profit after tax. Then extract from the statement of financial position, that's the balance sheet, right, 28 February 2023. Right, we got the closing balances, the closing balance sheet and the opening balance sheet. Right, inventories, right, you are only given the opening balance. Remember, you have to calculate this one. Right, then trade and other pay receivables, right, you're only given the opening balance as well. Cash and cash equivalents, right, there's nil there. Then shareholders equity, right, that's the total ordinary share capital, retained income, long-term loan, CBZ Bank, trade and other payables, shareholders for dividends, right? We're gonna need this one. SARS income tax is gonna need this one as well. Then bank overdraft, right? There's nothing there. It says items identified from the cash flow statement and notes on 28 February. Inventory, right? This is from cash flow statements and notes on 28 February. Right, inventory is 390,000 in the cash flow statement, and the indicators is an outflow. Remember earlier I said changes or movement of current assets, if they decrease it's an inflow, if they increase it's an outflow. So basically with this situation there was an increase in inventory compared to the closing or the opening balance, right? So the opening balance was less than the closing balance. Then cash flow from operating activities, outflow. Then cash flow from investing activities, it's an cash flow from operating activities is an inflow. Cash flow from operating from investing activities is an outflow, right? So those are the activities. So you have operating activities, investing activities, then financing activities, right, which you are required to calculate. Fixed asset, a new delivery vehicle was purchased halfway during the year. Right, the vehicle was purchased halfway during the year. The depreciation on the vehicle purchased was 44,175. Depreciation on vehicle is calculated 15% per annum on cost. Right, equipment with the value of 62,000 was purchased during the year. Ranga sold part of its building to one of the directors. So there was a sale, right, of the one of the building. Then ordinary share capital on 1 March 2022, the beginning of the financial year, the company had 2,500,000 shares in issue. That means shares that were in circulation. Then on 15 May 2022, 1 million more shares were issued. Ordinary shares were repurchased on 31 January 2023. I remember the year ends on 28 February. Right, by the directors at 1,500,000. This was the total cost, right, that they paid for the shares to the people that own the share, that had the shares, to buy them back. Then on 28 February 2020, the end of the financial year, there were 3,200,000 ordinary shares in issue, right? So 3,200,000 shares, right? That was the closing balance of number of shares, right? Dividends. The directors paid interim dividend of 5 cents per share, right? And the question is silent about whether the new shares that were issued were qualified for the dividend for the entire, because the shares were issued on 15 May and the dividend was paid on 30 September. If you need to include them, the question is silent, right? You're not given much information, you include them, right? But depending on the question, right, sometimes you find that the information that are given there is sufficient enough for them not to mention whether the dividend are excluded from the shares are excluded from the interim dividend or not. So the information will tell us. But if the question is completely silent, the treatment is they will be included, right? Okay, then a final dividend was declared on to all shareholders on 28 February, right, including the repurchased shares. So you see here the question specifies that repurchased shares qualified for what? For a final dividend. Then they say the total dividend paid and declared, right? Here's the key, right? Right, you see it's paid and declared. That means this is the total dividend. That includes interim and final. So here you can say paid, that's interim, then declared, that's the final dividend, amounted to 490,000. just have to be careful about reading those statements correctly, especially for an exam you're always in a rush, right? Okay, all right, then that will be the end of the question. Let's see answering the question, what we need. Right, we dealt with this, right, already. We said for this question here, it's non-current liabilities. Then here we said inflow, if my memory serves me well. Then here we said current assets. Then workings for inventory. Right, this comes from here. Right, remember this is an outflow. Right, so remember this is an outflow. So outflow, that means closing inventory was bigger than the opening inventory. And how much was it bigger? By 390,000. So you just add opening balance plus the difference, which was bigger, right? 390. So that's 1,450,000 plus 390,000. So that's 1,450 plus 390,000. That gives us 1,450 plus 390. That gives us 1,840,000. Right, that is it. That's why it's 2 marks. Then income tax paid. Income tax paid comes from here. Right, you have shareholders for dividends. You have sorry, not shareholders, income tax. You've got the opening balance and the closing balance. Then you have income tax for the year. So that's 358,440. So to calculate income tax paid, you add opening balance plus current year tax, then minus the closing balance. So that will be equal to opening balance 102,000 plus I guess 358,440 minus I guess 72,000, the closing balance, which is right here. Right, let's see what we get. That's 102,000 plus 358,440 minus 72,000. That's 388,440. Right. If you had to put it in a table, basically what you're gonna write is just underline its opening balance. That's 102,000. That's in brackets. Income tax, that's for the year. 358,000. Right. Then closing balance, that's 72,000. So this will give you exactly the same, right? It will give you a negative of 388,440. Right, so that's exactly what will happen. Then dividends paid. Dividends paid. For dividends paid, you are given two again. It's kind of like exactly the same. Right, you have to work them the same. You are given every information. You're not going to calculate any dividends. Right, if you look here, right, if you have the opening balance of dividends right here, right, right, you have the opening balance and the closing balance. The closing balance basically will be your dividend declared, final dividend. So this 315 is your final dividend. So to calculate, you're going to use exactly the same. right? And you are given the total dividend of 490 here. So you're going to do exactly the same way we did with taxation, right? So you have 65,000 plus 490 minus 315. So for dividend, you will have 65,000 plus 490,000 minus 315,000. Right, that is opening balance plus dividends for the year. That is the total, right? Minus the final dividend or the closing balance, right? So this will give you 65,000 plus 490,000 minus 315,000. That will give you 240,000 as the total dividend paid. Then right, then for calculating purchase of fixed assets, right, we have this question here. Fixed assets, right? So you have a vehicle that was purchased, and it was purchased halfway through the year, right? So if it was purchased halfway through the year, that means this depreciation represent half total depreciation. Remember, 15% is per annum, so it's basically half of the total depreciation calculated. Right, so you just reverse the way you calculate depreciation, because for you to calculate this depreciation, you are going to say x, right? X multiply by 100 by 15 over 100 times 6 over what? 12. That's how you're going to calculate. We don't know the value of x, but for us to calculate now x, because you're given because this resulted to what? 44,175. If you want to be mathematical, you can come up with an equation, but I don't want to number crunch you, confuse some of you in this kind of like regard. You're gonna make it sound simple. You just reverse this in a nice way, right? So this is what you're going to do, right? You come to your question, then you need to add this one too. So you come to your answer. So the working will be 44,175. Let me make sure I'm quoting the proper one. Yeah. Multiplied by 100, we just invent, over 15, multiplied by 12 over 6. Then all this plus 62,000. That's how simple it should be, right? So punching it, hopefully to come out correct. That's 44,175 times 100 divided by 15, right? Times 12 divided by 6. Right, that will give you 589,000 plus 62,000. So the total purchases for vehicles 651,000. At 651,000. Okay, so that will be for the vehicles. Right, then the next question was cash and cash effects of financing activities. So first is first, we have issue of shares. Right, then we have repurchases of shares. Then we have loan repayment I'll show you where I get all this. Right, issue of shares, we just put this figure down, right? So the repurchase of shares, that's a straightforward one. Sorry, I'm scrolling the wrong. Ordinary share capital, right? Shares were repurchased what? The directors at 1,500,000. So whatever number of shares that were repurchased 1,500,000. I don't waste time, right? 1,500,000. You can just put that figure down. It's there. You're done. Right, that's an outflow because money went out of the business. Right, then for issue of shares, it's a little bit of working there. Right, because of the information that we're given, right, you need to calculate how much was issued. Normally, if you know the value of the shares, how much was increased, normally you just subtract this opening balance from the closing balance, you get it. But now the problem we have is that there were shares that were issued during that were repurchased during the year, so you need to bring it back to the value before the shares that were repurchased were removed, so that you know exactly how much did the 1 million shares were issued for, because these 1 million shares here, right, we don't know at what price. If they give you like they were issued at 10 rand for per share, you just multiply 1 million times 10, then you get your answer. So what we need to do, we need to calculate the average price, right? Because at the end of the day, the total number of shares that are supposed to be there if there were no shares repurchased is 2,500,000 plus 1 million. That will give you 3,500,000. These are the total number of shares that are supposed to be there, but the question tells you that there were 3,200,000 shares. That means this represents 300,000 shares that were repurchased, right? So remember, when you are repurchasing shares, right, in your ordinary share capital account, shares are repurchased at average price. So what's our average price, right? This is represented by the 3 million shares. They are represented by this 13,440,000. So if you divide 13,440,000 by 13,440,000 divided by 3,200,000, right, this will give you 30,440,000 divided by 3,200,000. This will give you an average price of 4,420,000. Sorry, 420. That means these 300,000 shares from our books, right, the ordinary share capital from the books of Ranga, right, they were deducted from at what, the ordinary share capital. Remember, during the ordinary share capital account, they were deducted at what, at 4,420,000, right? So which gives you a value of so if you multiply this by 4 million, sorry, if I multiply the number of shares by the average price, that will give you, that's times 300,000, that will give you 1,216,000. We want to get them back to the value before repurchase to see how much the shares increased, or the ordinary share capital increased by after the new issue. So now when you come to your adjustment, we'll need this. So this is what you're going to write, calculate the correct one. So this one you're going to say 13 million, I think it's 13 million, 13,440,000 plus this 1,260,000 to get them back to before repurchases. 1,260,000 and another 0, then minus the opening balance, which is 9,700,000. Right, so we have 13,440,000 plus 1,260,000 minus 9,700,000. That's 5 million. That's an inflow. Then loan repayment. Loan repayment, basically are comparing this and this. So a loan started at 4,500,000, right? Then it decreased to 2,850,400. So basically it's just subtraction. So it's 2,850,400 minus 5 million. I think it's 4 million. Yeah, minus 4,500,000. 500. There was a loan, there was a decrease in loan, so you need to cater for that. That's 4 million, 2,850,000, 400 minus 4,500,000, 500. That's 1,750,000, 100. At 1,650,000, 100. And that's an outflow as well, right? You paid money, right? You paid money. So total cash effects in financing activities, right? We have 5 million minus 1,500,000 minus 1,650,000, 100. That's 1,849,000. 900. 1,849,000, 900. So it's just number crunching. Once you know what you're doing, it becomes easy and straightforward. Right, then you go to net change in cash and cash equivalents, right? If you don't know the format of this, it becomes a little bit difficult. At the net change in cash and cash equivalents, right, you have to add these three figures, right? You have to add, when I say add, literally supposed to add, but if it's a negative, you subtract. You're supposed to add, right, operating activities, cash flow from operating activities plus cash flow from investing activities, plus cash flow from financing activities, right? The one that is an outflow is negative, right? So that will be cash from operating activities. Say it's an inflow, that's a positive. That will be 862,700. Right, I'm taking this figure because they said it's an inflow, minus because they said it's an outflow, 3,132,600. Right, then if you go to our solution, let's say maybe in working out, right, whatever figure that we came up with, just use it, right? Just use it, right? Then this is inflow, right, from our calculation, because 5 million minus this, it will give you this, right? 5 million is more than these two, right? So plus 1,849,900. So you get your net change in cash and cash equivalents of negative 420,000. Right, then you add opening balance, right? Right, our opening balance is this one here, right? We have this, that's our opening balance. That's why they didn't give us the closing balance, because we're supposed to work it out. So you add 382,000, so that plus 382,000, you get a closing balance of 38,000 overdraft. Right, that's an overdraft. The next one is net profit on tax before sales, right? Percentage net profit is straightforward, right? Net profit before tax. So net profit before tax, right? You're going to say 1,066,340 minus the tax, minus the interest expense. Sorry, right? So this will be 1,066,340 minus the interest expense 128,460. Right, all divided by your sales, that's 8,240,000 times 100 over 1. They never likes to comment on this, right? So 1,066,340 minus 128, right? Divided by divided by 8,240,000 times 100, right? That will give you, I think, 11, if I calculate correctly, 0.38%. The next one is current ratio, right? Current ratio we dealt with in the previous question 1. Current ratio is current assets is to current liabilities, right? So our current assets, total current assets, right, it's 1,430,000. Current liabilities, it's 650, right? So this will be 1,430,000 is to 650,000. So divide your current liabilities into your current assets. So that's 1,430,000 divided by 650,000. That will be 2:2. 2.2 is to 1. That will be 2.2 is to 1. Then the next one, dividends per share. Dividends per share. Dividends per share basically calculating like the price per share, how much dividends are given per each share. Right, if you come to our question here, right, if I scroll down to share capital, right, the total dividend was 490,000. The total shares were 3,500,000. Right, So at the end of the day, what you are calculating basically is how much was each dividend, like dividend per share, that price per dividend, right? That is per total dividends, right? So that would be total dividend divided by the total number of shares. Remember the 300,000 shares here, these ones qualified for the dividend, right? So in calculate dividend per share, we use the total dividends during the year that qualified for a dividend. Going back to our question here, formula that are given in the question, you need to pay attention to those formulas, right? I'll scroll down to those formulas. We can open them and see them. Right, so in this question, basically the formula for dividends, percent return on shareholders equity, right? Calculating this here, percent return on shareholders equity. The formula basically, when you're looking at the formula, is profit after interest and tax, right, divided by average shareholders equity. So that's profit after interest and tax divided by average shareholders equity, right? So if you come to our question, right, profit after interest and tax, that's net profit after tax, right? Net profit after tax, that's 836,660. That's 836,660 divided by average shareholder, that will be the opening plus the closing shareholders equity, divided by 2, right? So if you come here, we have this and this, so the shareholders equity, that means 30,941,500. That's 13,941,500 plus 10,312,350, 10,312,350, all multiplied by what? Half, right? Times 100 over 1, right? So let's work out the bottom first. We've got 13,941,500 plus 10,312,350, right, divided by 2 times half. That means basically divided by 2, right, to get 12 million. So that will be 836,660 divided by 12,126,925. All this multiplied by 100 over 1, that's 100%, right? So that will be 836,660 divided by 12,126,925 times 100. That's 6 round of 6.9%. 6.9%. So that will be your question, there was really nothing. They didn't ask you to comment on them. Normally they'll ask you to comment if you're given sufficient information, but I think the next question, that's where there's commentary on financial analysis. That's basically what you needed to do, right? Please, if you haven't watched the previous video on question 1, can you just look for it? It's actually specified prelim paper 1 question 1. This is the question 2 part of it. I hope you found this helpful, and if you did, please share with those that will really be helped by this, and at the same time you find it helpful, please do subscribe to my channel, as I'm trying to get these tutorials across, so it reaches as many people as it can. So the next one will be on question 3. I think that's the financial analysis, right? Those formulas, I believe they are on the last page. Right, before I forget, let me just show you the formulas, the formula sheet. Right here it is. Right, so this is the formula sheet that you are given. They even tell you right, more information, shareholders equity, right, everything. They don't tell you which one is which, but you should know. Sorry, right, you should know. Right, so you have all the formulas here. You're given a formula sheet, so you just need to pick up the right formula for the right thing that you want to calculate, so make use of it. Right, if you don't know, because remember they are not writing which one is which, you need to know which formula is for which one. Right, it helps for you to have a good understanding and knowledge of it. Right, other than that, please do subscribe to this channel if you find it helpful, and please share with others. Thank you.